Okay, hey, Ryan here with James for the weekly mortgage update. We're going to jump right into some interesting deals and products of the week, right, James?
Hey, Ryan. Yes, we are.
So you were telling me about construction jumbo. Never occurred to me. I assume that means somebody wants to build something who has a high loan amount.
Exactly. So, the agencies like Fannie and Freddie have done a really good job. Obviously, we always talk about the home style renovation loan, the 203K loans, but there really has been a lack of jumbo construction money out there. So the people that maybe own that $800,000 house and they're because of the area they're in, they could knock it down and get another 800 for construction, and then they have a $2 million house. That product is not readily available today. So we've had some tractions with some investors to say, obviously in areas like, Bergen and Hudson County here in New Jersey, that it's, with everything of, the lack of inventory and also that's out there, that you can give this jumbo product to people to purchase homes or obviously work on their current home and do. It's really a good development, and it just goes to what we've always, we've been talking about here, that real estate is back, and some of this liquidity does need to come back into the marketplace. And yes, this program, you're going to show tax returns, it's going to go off of your income. You have to show good reserves and good credit. So it's not 2005 and I'm all of a sudden now I'm a contractor and I'm going crazy building houses. That's not the case. It is going to be, tailored to really high net worth individuals. So you are going to be highly scrutinized in underwriting, but we know the parameters and this money is available, which otherwise really has not been available in the marketplace.
Cool. So it's jumbo. I know it's different in different parts of the country, but in Jersey, what are we talking about? 6 something?
Yeah, jumbo conforming limit, high balance limit in New Jersey is 636,100. So it would be for any loan amounts above that, based on the purchase price plus the amount of construction needed.
All right. So say I see a house that's for sale. Say I see a fixer upper. It's in a really good area, and they've got its total shell. It's like 350, and I want to knock it down and put something there. It's going to cost me a couple $100,000 to build something, and it'll be worth $1 million after. Can you do that as long as the loan amount is over 636?
Yep. I mean, we can do that even with the loan amount being under 636 with the home style loan. So if you're building off the existing foundation and you're technically leaving up one wall, that is considered rehab. The only thing with the rehab loans is that the amount of work cannot exceed 50% of the after appraised value, which usually doesn't happen, but I do want to share that with you. So if you're buying a house for 400,000, let's say in this scenario, and it needs 400,000 worth of work, as long as the after appraised value is 800,000, you're fine. So, regardless of the amount of money you're putting down, that's always going to be the test on that. But obviously, I don't know anyone out there that wouldn't at least have that house worth 800,000. So, like I said, it's not usually, an issue, but the construction amount or the rehab amount cannot exceed 50% of the after appraised value.
Okay. What do rates look like on these compared to conventional? Is it just regular jumbo rates or is it a little higher?
Yeah, I mean, they're a little bit higher, even on the rehab, conventional, and the jumbo. So the jumbo product is a little more unique, okay, because it's a construction to perm. For those of you that were around in 2004 and 5, you probably remember that word well. So it will be a one close. You will pay interest only during the construction period, typically around 5.5%, 6% interest only on the amount that you draw. So let's say you're buying the house, and typically that would require your 25, 30% investment right there up front. If you're, so if you're buying the house for 800,000, you're putting 200,000 down. That 600,000 is immediate, right? So you're going to pay interest on that 600,000 plus the additional draws as we go through the construction, which can typically be 12 to 18 months.
Okay, so and then the opportunity here is instead of buying something that's totally done, that might be on the market for say $1 million. You can go find that beater, that fixer upper in the 7-8 range, put some money into it, and have more equity at the end of the day, and customize it to your taste.
Definitely, absolutely.
Right. So if you have the patience and you're willing to and you want to create your own, customize your home, this is a good option.
Yep.
Okay, and then the other thing you've been doing a lot of, I know, is this self-employed stuff, but you want to remind everybody, you're doing 1 year self-employed tax returns.
Yes. So as long as you've been in business for 5 years, we can use your most recent year's tax return to qualify.
Right.
And that allows us to do some unique things on the jumbo side as well. Again, here in most of New Jersey and northern New Jersey, the max conforming loan limit is 636,100. So we get very creative for the, especially we talk, again, always looking at the self-employed and helping the self-employed individual, who is by far the most underserved individual in the mortgage market today. We could give you a $636,000 first mortgage for a 30-year fixed, or anything you'd like to see program-wise, 10-year ARM, 7-year ARM. And then also we work with some credit union partners that we have to give you the additional in the form of a line of credit second. So a great scenario that I can share with you is a 1,125 purchase, or let's use that 1.2 that you have up there.
Right.
And you're going to put 10% into the deal, which is $120,000 as your down payment. So you're at $1,020,000 there, and so the difference between the $1,020,000 and the $636,000, which is $384,000, we're going to give you in the form of a line of credit second, based off of prime, and it's prime plus typically prime plus 2.5%, somewhere in that range. So it isn't overly expensive. It isn't so cheap today, but if you look at it from, again, you're self-employed, for tax purposes, you want to be efficient. You're going to have that big chunk of it, the 636 locked in 30-year fixed rate somewhere around 4.3, 4.5 today, and the second line of credit, which you can pay down and still have available, the available balance to use, which, being self-employed, it's always great to have a little extra cash flow there. And really what I tell clients is focus on that second line, right? Since it is adjustable with to prime, which already has gone up, 75 basis points based on the Fed moves here. And so you may want to just throw any extra principal you have towards the line of credit, so you're not paying that extra interest or exposed there too much. And again, if you need it for a rainy day, it's also there for you to take it back.
Cool. Okay. So, yep, self-employed as usual, and big jumbo construction stuff. If you know anybody who could use either of these products or something like them, James is available. And you have a couple guys on our team who are really well versed in this stuff too.
Yes, absolutely.
Yeah. So where are rates now in general compared to maybe where they were a few weeks ago when we last spoke?
Yeah, they're kind of, holding around the 4% mark. They had jumped up. The last, I would say in the beginning of the month, they jumped up towards the 4.25, 4.3 range, and now have steadily trickled back down. So rates is not an event for this year. The data and the numbers are making me look good, because they're backing up what I've been saying. I don't see any the economic numbers show there is no inflation yet in the economy. Producer prices are still tame. Consumer price index looks good. The manufacturing indexes continue to disappoint here in the U.S. on the cheap side. And wages are not growing at the pace that would otherwise indicate inflationary pressure. So you do look at the 10-year bond today, and I think we're somewhere in the mid-2.2 range, 2.23, looking at it real time. And so we had jumped up to 2.38 not too long ago and started trending back down. We were as low as 2.10 probably early June. So we're right in the middle of that range, which is exactly where I expected us to be. And what's very interesting here, you throw in the low price of oil. I can't remember, and anyone out there really, if you can stop and think about this for 1 second, when was the last time that interest rates were on the lower side during the height of the spring market and gas was on the low side during the busy driving season in this country? That is giving the consumer that extra, little room to build confidence in the fact that, hey, and like I said last time, real estate is back. Residential real estate is back. So I think that just is going to translate into more buyers. It definitely sounds like a seller's market out there today, but I think that is all great things that are filling our pipeline as an industry, that we're going to just continue to see this. And look, we don't need gangbusters growth here. We just need steady 2 to maybe 3% economic growth. And that is going to be tremendous for the real estate, mortgage, housing industry.
Right.
And we're a much better foundation. People, just using a lot more common sense today about things.
Right. So if you're a lot of people, got stuck holding on to a lot of stuff they were building, builders in particular, speculators, now is probably a fairly safe time if you can find a contractor even, but if you can build something, there's a good chance you could be out of it without too much risk, right? With the seller's market,
Yeah.
the money's cheap.
For me, I believe in the people of this country. I always have. I know I say maybe it sounds corny, but I believe in the American dream. It is about the people. Obviously, Washington is kicking out of its own way, but we are resilient as an economy, as a working class. The dot-coms, the same thing happened where telecom built out, the capacity for 15 years. The NASDAQ went from 5,000 or 51 and change down to 1,000. The housing market, you can really relate some of the same things. And what caused those things was leverage. They kept throwing money at it, and they popped the bubble. Right now, there isn't a great deal of leverage. And I don't care what anyone says out there. Self-employed, you have, first-time home buyer. If you deserve a mortgage, we're going to find a way to get you a mortgage, and you can get a mortgage in this environment with working with the right people. But now that inventory, like you said, Ryan, is perfect. That inventory has been absolutely absorbed over, from 2009 to, as I would say, up to 2014. I would say 15 and 16 were balanced markets, and now it's a seller's market. And because a lot of the money has not gone to spec building or even giving the individual home buyer the ability, like I said, to do that jumbo construction project because they see the value in doing that. So we don't need leverage. We need consistent growth. And, I think we're really on the way back, and we are back in housing, and we'll continue to stay there like we did the 60 years before the crash. And hopefully we learned the lessons and not make the same mistakes.
Great. Okay. So last thing, James, I'll just touch upon what we've a little bit of content for agents on our site. If you're an agent watching this, of course, we still have our open house form. Some people have been asking about this. It's right under the tools menu. You just go to open house form. You can create a sign-in form for your open houses. It's very easy to use. You used it, right, James?
Yep. Excellent.
So it creates you a link. You just have your phone, your tablet, your laptop out at the open house. People can sign right in, and you'll get emailed all the registrations in real time. Sorry to cut you off there.
Nope.
And the next thing, one little thing. Real estate seller lead generation. James, I spent a lot of time in Facebook messing around with funnels for agents, and I've recently stumbled upon something pretty interesting. So if you're an agent watching this, it should be one of the most recent posts here around, where are we, July 21st. I posted yesterday, the 20th. You can watch a little 2 or 3 minute case study. It involves something near and dear to our hearts, James, texting. And what we're doing is we're driving Facebook homeowner leads to get a list of recent transactions in their area, but we're instantly texting to ask about their motivation to sell. With some interesting results. So that's it. You got anything else, James?
No. Thanks, Ryan. Have a great weekend.
You too. Talk soon.
Talk to you soon. Thanks.